There's one company you need to know about. It's not Apple, not Amazon, not Google. It's BlackRock. They manage $13.5 trillion. That's more money than the GDP of every country on Earth except the US and China. They're the largest shareholder in Apple, Microsoft, Amazon, Tesla, JP Morgan, Bank of America. Basically, every major company you can think of. But here's what nobody's talking about. BlackRock doesn't just manage money. They control three critical parts of your life in ways you've never realized. First, they're buying up houses. Not directly, but through companies they fund, making it harder for you to ever own a home. Second, when you invest in an ETF or index fund for retirement, you're handing them voting power over the companies you technically own shares in. They vote your shares, not you. And third, when the government needs to bail out the economy during a crisis, they don't call the Treasury or the Fed's own staff. They call BlackRock. The same company managing private wealth is also managing public crisis response. This isn't conspiracy. This is how the system works now, and once you see it, you can't unsee it. Let me break down exactly how BlackRock touches your life, whether you know it or not. Let's start with something personal. Trying to buy a home. You find a house, 3 bedrooms, good neighborhood, $380,000. You make an offer. Your agent calls back. Sorry, it's sold. Cash offer. Closed in a week. You lost to an investor. Again. Now, here's the thing. It's probably not BlackRock directly buying that house. But let me explain why they're still part of the problem. After the 2008 crash, a private equity firm called Blackstone, confusing name, I know, different company, saw an opportunity. Housing prices had cratered, foreclosures everywhere. So they created invitation homes and started buying single-family houses by the thousands. Not 5 or 10 properties like a small landlord, 50,000 homes. It was a brand new business model. Treat single-family rentals like a stock portfolio. By 2017, Invitation Homes owned 82,000 properties. They went public. Blackstone eventually sold their stake for $7 billion, more than double what they invested. But the industry didn't disappear. Today, Invitation Homes still owns over 84,000 homes. American Homes 4, Rent owns 59,000. Progress Residential owns 83,000. Across the country, institutional investors own about 574,000 single-family rental homes. Nationally, that's only 3 to 4% of all rentals. Sounds small, right? But look at specific cities. In Atlanta, institutional investors own 25% of single-family rentals. Phoenix, 20%. Charlotte, 22%. Tampa, Dallas, Jacksonville, all have huge institutional ownership. In some Atlanta zip codes, just 3 companies own 19,000 homes. So where does BlackRock fit in? BlackRock doesn't directly buy your house, but they manage money for institutional investors, pension funds, insurance companies, sovereign wealth funds, and some of that money flows into real estate funds that own these rental companies. BlackRock also provides financing and risk management tools to these companies. When Invitation Homes wants to raise capital by packaging rental income into bonds, yes, that's a thing, BlackRock's involved in structuring and selling those securities. It's indirect, but the web connects. Here's why this matters for you. Institutional investors have structural advantages you'll never match. They pay cash. You need a mortgage that takes 30, 45 days and could fall through. They close in a week with no contingencies. They buy before listings go public. They use algorithms to identify properties months ahead. Some cut deals directly with home builders, buying entire neighborhoods before construction finishes. In 2021, an investment firm bought 124 brand new homes in Conroe, Texas, straight from the developer. You never had a chance to bid. They don't care about price the way you do. You're thinking, can I afford this payment? Will I be happy here? They're thinking, what's the 10-year IRR? Does this pencil across 10,000 properties? They can overpay on individual houses because they're optimizing at portfolio scale. They have economies of scale you can't match. You hire a plumber for $200. They have regional maintenance teams and bulk supplier contracts. Their per unit costs are lower. Once institutional investors own neighborhoods, tenant experiences often decline. A 2016 Federal Reserve study found that institutional landlords evict tenants significantly more than small landlords. Why? Because their business model is optimized for cash flow, not relationships. In 2024, Invitation Homes settled with the FTC for $48 million after being accused of hidden fees, unjustly withheld security deposits, and misleading eviction policies. Bond data analyzed by Reuters showed Invitation Homes spent an average of $140 per year on maintenance per property. Compare that to the typical homeowner spending $3,100 annually. Why? Every dollar saved on repairs flows to bondholders. Tenants reported fast fixes for cosmetic issues, but delays on major problems, foundation issues, mold, HVAC failures. This hasn't gone unnoticed. In 2025, President Trump proposed banning large institutional investors from buying single-family homes. The announcement tanked shares of Invitation Homes and others. Red states like Florida and Texas, not exactly anti-business, have debated restrictions because voters are furious about being outbid by Wall Street. But here's what people miss. Banning institutional investors won't solve the housing crisis. The real problem is we're not building enough houses. Institutional investors target markets with housing shortages. If Atlanta, Phoenix, and Charlotte were building enough to meet demand, investors couldn't extract these returns. As UCLA professor Michael Manville put it, institutional investors like to buy in the Bay Area because the Bay Area doesn't build housing. These companies feed off scarcity. Institutional investors are a symptom, not the cause, but they're making the problem worse by consolidating supply and extracting maximum value from scarcity. But housing is just one way your wealth is connected to BlackRock. The bigger issue? Your retirement savings. When you invest in index funds and ETFs, you think you own shares of Apple and Microsoft. But there's a twist most people don't realize, and it gives BlackRock enormous power. Let me show you. You've got a 401k, maybe an IRA. You're invested in an S&P 500 index fund or an ETF because that's what everyone says to do. Diversify, low fees, smart, right? Here's what they don't tell you. When you buy that ETF, you're not just buying shares, you're giving away your voting rights. When you buy shares of an S&P 500 ETF, let's say iShares Core S&P 500, that's BlackRock's flagship ETF with $435 billion, your money buys tiny pieces of all 500 companies in the index. You technically own shares of Apple, Microsoft, Amazon, Nvidia, Tesla, all of them. But here's the catch. You don't get to vote those shares. BlackRock does. Every year, public companies hold shareholder votes on major issues: board elections, executive pay, mergers, ESG policies, corporate strategy. Shareholders get to vote based on how many shares they own. But when BlackRock holds shares on behalf of millions of ETF investors, they get to cast those votes. Not you. BlackRock manages $13.5 trillion. About 55% of that is equity, roughly $7+ trillion in stocks. They're the largest shareholder in Apple, 7% plus, Microsoft, 7% plus, Amazon, 6% plus, Alphabet, Tesla, JP Morgan, Bank of America. The list goes on. Add in Vanguard and State Street, the other two giants, and together they control over 20% of the S&P 500. Think about that. 3 asset managers collectively control 1/5 of America's largest companies. When BlackRock votes, they're not just voting their own money. They're voting your shares, your pension fund's shares, your university endowment's shares. Every January, BlackRock CEO Larry Fink sends a letter to every Fortune 500 CEO, and they listen, because he controls trillions in their stock. In these letters, Fink lays out priorities: climate risk, board diversity, stakeholder capitalism, long-term thinking. Companies pay attention because if BlackRock decides to vote against management or divest from a company, it's a big deal. This has made BlackRock a punching bag from both sides. Progressives say BlackRock talks about ESG but still invests heavily in fossil fuels. They're greenwashing. Conservatives say BlackRock is pushing woke capitalism, forcing companies to adopt left-wing social policies. Both sides have a point. BlackRock is simultaneously the biggest investor in renewable energy and the biggest investor in oil and gas companies. They're playing all sides. Here's the frustrating part. If you disagree with how BlackRock votes, tough luck. You own shares of Apple through their ETF. BlackRock votes those shares for board members you might not support, or on climate proposals you might disagree with, or on executive pay packages you think are too high. You have zero input. This isn't unique to BlackRock. Vanguard and State Street do the same thing. But BlackRock is the largest, so they wield the most power. To be fair, BlackRock has started addressing this. In 2022, they launched Voting Choice, a program letting some clients direct how their shares are voted. As of 2025, nearly half of BlackRock's index equity AUM is now eligible for Voting Choice. In 2024, they even opened it up to retail investors in their flagship S&P 500 ETF. You can now choose from 6 different proxy voting policies, some focused on climate, some on corporate governance, some faith-based. But here's the reality. Most people don't use it. It's complicated, buried in account settings, and requires active participation. Most investors don't have time for. As of late 2023, only $598 billion of eligible assets had opted into Voting Choice. That sounds big, but it's a small fraction of the $7+ trillion in equity BlackRock manages. The vast majority of votes are still cast by BlackRock's investment stewardship team on your behalf. Is this a problem? Depends who you ask. BlackRock's argument: we vote in clients' best long-term financial interests. We engage with companies year-round. We support good governance. And now we're giving clients more choice. Critics' argument: concentrating this much voting power in 3 firms, BlackRock, Vanguard, State Street, creates systemic risk. When the same investors own competitors, like all the major airlines or all the big banks, does competition suffer? Does innovation slow down? Academic research has found that common ownership, when the same funds own competing companies, can lead to less competition and higher prices. If BlackRock, Vanguard, and State Street all own United, Delta, American Airlines, and Southwest, do those airlines really compete as hard? Or do they tacitly avoid price wars because it hurts all their shareholders? If you're invested in BlackRock ETFs or Vanguard or State Street, here's what you can do. Check if voting choice is available in your accounts. If so, pick a policy that aligns with your values. Diversify your fund providers. Don't put everything in one asset manager. Consider actively managed funds where managers are more accountable, or smaller fund companies where you might have more voice. Push for reform. Regulators could require asset managers to make voting easier and more transparent. Some have proposed letting retail investors vote directly, like shareholders in individual stocks. But the honest truth? Most people won't do any of this. It's too complicated, too abstract, too much work. And that's exactly how the system consolidates power. But there's a third way BlackRock controls things. And this one's different because it's not about private wealth. It's about public crisis. When markets break and the government needs help, there's one company they call. And that relationship gives BlackRock access and influence that goes way beyond normal investing. Let me explain. September 2008. Lehman Brothers collapses. The financial system is imploding. Treasury and the Fed are facing a massive problem. They're holding billions in toxic assets from failed banks, and they don't know what anything is worth. Without prices, they can't stabilize markets. So who do they call? Not Goldman Sachs, not JP Morgan, BlackRock. It actually started earlier. In March 2008, when Bear Stearns imploded, the Fed needed someone to value $30 billion in complex mortgage securities as part of JP Morgan's emergency acquisition. They hired BlackRock, specifically BlackRock's Financial Markets Advisory Group. Why? Because BlackRock had the best risk management technology, Aladdin, and they weren't conflicted. They weren't trying to buy the assets cheap or sell them high. They were neutral. That was the audition. When the real crisis hit 6 months later, BlackRock became the government's go-to crisis manager. After Lehman, the Fed created Maiden Lane LLC to manage toxic assets from Bear Stearns and AIG. Total value, $130 billion of the most complicated illiquid securities in existence. BlackRock got the contract to manage all of it. They decided what to sell, when to sell, how to restructure positions to maximize taxpayer recovery. They ran everything through Aladdin. The same platform managing pension funds was now running the Fed's crisis portfolio. Think about the information this provided. BlackRock saw which securities were truly worthless versus just illiquid. They saw which banks were desperate sellers. They saw the entire structure of the toxic asset market in real time. That's intelligence you can't buy. Then, in November 2008, the Fed announced it would buy $1.25 trillion in mortgage-backed securities to stabilize housing finance. But the Fed doesn't have trading desks or portfolio managers, so they hired BlackRock to execute the entire program. BlackRock's team made every purchase, managed every position, monitored every risk. The Fed provided the money, BlackRock provided the execution and intelligence. And here's the uncomfortable part. BlackRock's asset management division was also trading in these same markets for private clients. BlackRock maintains strict information barriers, separate teams, compliance protocols. By all accounts, they followed the rules. But the optics? When you're both advising the government on intervention and managing private money in the same markets, the potential for advantage is obvious. March 2020, pandemic hits, markets crater. The Fed needs to restart the crisis playbook. Once again, they turn to BlackRock, this time for 3 emergency programs: corporate credit facilities and commercial mortgage support. Combined firepower, over $500 billion. Again, BlackRock's deciding which bonds to buy, how to structure programs, how to maximize impact. And again, BlackRock's regular business is in these same markets, managing bond ETFs that benefit from Fed support while executing that support. It's not just crisis response, there's a deeper relationship. Multiple senior government officials have come from or gone to BlackRock. Brian Dees, BlackRock's global head of sustainable investing, became Biden's director of the National Economic Council. Michael Pyle, BlackRock strategist, became chief economic advisor to Vice President Harris Adewale Adeyemo. BlackRock executive became deputy treasury secretary. This is common in finance. Goldman Sachs has the same pattern. But BlackRock's government relationships are especially tight when markets break. Here's what keeps some people up at night. The government has become dependent on BlackRock's infrastructure. BlackRock didn't engineer this. They built good technology, executed well during emergencies, earned trust. But the result? When the next crisis hits, the government doesn't have a backup plan. They don't have alternative infrastructure at this scale. BlackRock's Aladdin platform has become critical crisis infrastructure. Privately owned, not publicly regulated. You might think, so what? If BlackRock helps during crises, isn't that good? Maybe, but consider. Your tax dollars pay interest on government debt that BlackRock helps manage. BlackRock gains enormous market intelligence from crisis programs that their private clients indirectly benefit from. The company advising the government on financial stability also profits from that instability. There's no oversight mechanism ensuring this relationship serves the public interest. It's not corruption, it's structural entanglement. So let me bring this all together. Because when you step back and see the full picture, housing, retirement, government, you realize BlackRock isn't just another investment firm. They're infrastructure. And that raises questions about power, accountability, and what happens next. Let me recap what we've covered. On housing, Wall Street firms, funded and supported by giants like BlackRock, bought over 500,000 single-family homes, concentrating ownership in specific cities, making it harder for regular people to compete, and turning neighborhoods into corporate portfolios. On retirement, when you invest in index funds and ETFs, you're giving asset managers like BlackRock voting control over the companies you technically own. They cast votes on your behalf, over $7 trillion in equity, and most investors have no say in how those votes are used. On government, when financial crises hit, the government doesn't rely on its own capabilities. They call BlackRock to manage bailouts, execute emergency programs, and value toxic assets. This creates a dependency where private infrastructure becomes essential to public crisis response. What ties these three together? BlackRock manages $13.5 trillion, more than the GDP of every country except two. They're the largest shareholder in most major corporations. They're the government's crisis manager. They're embedded in housing finance, retirement savings, corporate governance, and public policy. This didn't happen through conspiracy. It happened because BlackRock built better tools, executed well, and earned trust across multiple domains. But the result is a level of influence that goes beyond normal market participation. Depends on your perspective. Optimistic view, BlackRock provides valuable services. They help people invest for retirement at low cost. They improve corporate governance through active engagement. They help governments stabilize markets during crises. The system benefits from their expertise. Pessimistic view, concentrating this much power over housing markets, corporate voting, and government crisis response in one firm creates systemic fragility. What happens if BlackRock has its own crisis? What happens when everyone's using the same risk models, voting the same way, responding to the same signals? Realistic view, probably somewhere in between. BlackRock provides genuine value, but the concentration creates risks regulators haven't fully addressed. A few things would help. 1. More transparency. BlackRock should publish detailed data on proxy voting, crisis work for government, and real estate investments. Sunlight is the best disinfectant. 2. Easier voting access. If millions of people's shares are being voted, those people should have a simple, clear way to direct those votes, not a complicated opt-in buried in account settings. 3. Regulatory oversight. And when a private company becomes essential infrastructure for government crisis response, there should be oversight ensuring it serves public interest, not just shareholder returns. 4. Housing supply. None of the housing problems get solved without building more homes. Period. 5. Competitive alternatives. The best check on concentrated power is competition. Regulators should ensure barriers to entry don't prevent new players from emerging. What you can do. On housing, show up to local zoning meetings and support construction. Ask representatives about housing policy. Understand that blaming Wall Street is emotionally satisfying, but misses the supply problem. On retirement, check if your funds offer voting choice and use it. Diversify across fund providers. Ask your 401k. Plan about proxy voting policies. On government, ask your representatives about the revolving door between finance and government. Push for transparency in crisis response programs. Support reforms that reduce dependency on private firms for public functions. BlackRock isn't evil. They're not conspiring to control the world. But they've become so large, so embedded, so central to multiple systems, that their influence raises legitimate questions about concentration, accountability, and systemic risk. You deserve to know that one company touches this many parts of the financial system. You deserve regulators asking hard questions about whether this level of concentration is healthy. You deserve a voice in how your investments are voted, how your neighborhoods are shaped, and how government uses private firms during crises. Drop a comment. Did you know BlackRock was this big? Do you invest in their ETFs? Will you check your voting options? Should companies this large be regulated differently? What worries you most? Housing, retirement voting, or government dependency? I want real opinions. Because this isn't just about BlackRock. It's about how modern capitalism concentrates power and whether we're okay with that. This is education, not financial or investment advice. I'm not telling you what to do with your money, where to invest, or what to think. This is based on publicly available information. Do your own research, consult professionals, make your own decisions.